fees are always something that are forefront in our mind.
Yes.
And I would suggest that just because something is cheaper doesn't necessarily mean that it's better. It's really the value of something that we should be looking at.
You're absolutely spot on. There's a big difference between price and value in all things that you buy.
Yes.
You know, a cheap pair of shoes might last you a couple of months, whereas if you spend a bit more money, they might last you 5 years.
Yeah.
And that's the difference between, you know, the price and the value. And it's the same when you're investing as well. So fees are incredibly important, both in terms of their absolute size. So are you paying 0.2% or are you paying 2%?
Yeah.
And really fees should be partly reflective of what is the fund actually trying to achieve.
Welcome to the Teaminvest Wealth Builder podcast, where we help you build smarter wealth and make more confident investment decisions. Well, welcome back to the Teaminvest Wealth Builders podcast. As you know, we focus on compounding your wealth and your education. So what we wanted to do was we wanted to take this opportunity to focus on something a little bit different to what we usually do, and that's focusing on funds. It's really important that when someone's investing in a fund that you know what you're investing in and making sure that it's right for you. And also that you know the outcomes and the expectations that you should have on that fund to try and avoid the majority of disappointment. So this is a fairly in-depth episode. So we decided that we'd actually break it into 2 episodes. So we'll have a part 1 and a part 2. So I'd encourage you to listen to both. We also have a tool that's available to support you and the learnings from both of these episodes that will be available in the show notes on the back of both of these episodes. So please sit back and enjoy these episodes. I hope that you find them really informative. This week, I'm joined by Stuart James. Stuart has just joined Tip Group as our head of distribution. Stuart has an extensive background, which he'll share with us, around funds management. And he was the key person for us to have this conversation where we delve into how to recognize if a fund is a good fund. So Stuart, thank you for joining us today.
Oh, thank you.
And welcome on board. Congratulations.
Yeah.
So we might start off by covering what's your background? What's your experience with funds management?
Sure. So my career actually started nearly 30 years ago up in the north of England, hence the accent. And from there I moved up to Scotland and then I moved out to Australia in 2001. So yeah, I actually began working for a company which ultimately became the largest fund manager in Europe. Looking after clients from a servicing point of view, marketing, selling funds, also helping with product design and bringing funds to the market. So yeah, hopefully over 30 years across multiple asset classes, I've got a lot of experience around funds and yeah, hopefully I can share some of those insights today.
Sounds like you're the perfect person to have this conversation with.
Hopefully.
So let's get today running. How do you work out what a good fund looks like?
Yeah, look, that's a great question because there's so many funds out there.
So many.
Yeah, it's really hard. I think probably the best way to think about it is investing in a fund is not that different to investing in a company.
Okay.
So first of all, you really need to your research to find the best opportunities that are out there. And Teaminvest members will be very familiar with our own process. Of course, our process starts with Conscious Investor, which is a great piece of software which allows you to go through all the fundamentals around a company. Now, with a fund, it's a little bit hard to do that, and certainly we can't, unfortunately, use Conscious Investor for that purpose. But the second part of our process, the SMART analysis, really does lend itself to looking for great quality companies and great quality funds. Yeah.
And we talk about our SMART analysis, which is strategy, moats, risk, and trustworthiness.
Yes.
Okay, so let's start with the first bit. If we look at strategy, how do we look at strategy for funds?
Great question. Look, I think first of all, you need to think about your own strategy. So what are you looking for? You can't really go and pick a fund until you actually, know in your own mind, what are you trying to achieve? Yeah. So are you looking for growth? Are you looking for income? Are you looking for a mix of both? Are you risk averse? Or are you looking to put some money into something which is perhaps a little bit riskier in the hope that you'll generate a better return? And then you need to start thinking about which asset class do you want to invest in. So is it equities, fixed income, property, infrastructure? So you're quite right. The starting point really is, what are you trying to achieve? How do you want to go about accessing that through those different asset classes?
Yeah.
And then a really good starting point is perhaps to go to a website like Morningstar or Money Management, where you can get a list of all the funds in those particular categories.
Okay. So if we use our SMART process, so if you've been listening to this podcast for a while, you'll be very familiar with our SMART process and how we apply it across companies. So let's take equities. You mentioned that there are a number of different asset classes, but let's look at equities and let's apply the SMART across that.
Yep.
So what's the next step? What's the next considerations in taking that next step and discovering which fund you would like to use?
Sure. So if you decided you want to get some exposure to equities, which I think is a great strategy, the next real decision is, do you want to be active or passive? And what do I mean by that? Well, a passive investment just simply tracks the market. So there you're really looking for a market return, which is absolutely fine. However, if you're a long-term investor, perhaps you actually want to beat the market. I think that's what we all strive to achieve. So you might be looking for a strategy which is more active. And we'll maybe talk a little bit later on about what I mean by active and kind of what the hallmarks are for a great active fund manager. Also, though, within the equity space, you've still got a huge range of choice. You can invest in Australian large caps, Australian small caps, global equities, perhaps even single country funds. So, yeah, huge choice of different strategies and different fees as well across those different strategies.
So it sounds like the starting point is firstly understanding what you want to achieve, and then going through the next step of looking at the asset class that you want to invest in, or you may want to invest across a number of asset classes.
Absolutely.
But for today's example, we're going to look at equities. And then it's having a look at, it's almost like sub-asset classes, isn't it?
Yeah.
Now, you mentioned large caps, small caps, mid caps. I'm guessing that we're not talking about coffee.
No.
What is? Can you explain that term just a little bit more?
Yeah, look, we have a lot of jargon in this industry.
We
So,
do.
yeah, we talk about small cap. Cap stands for capitalization. And really, it's just a sign of how big is the company.
Okay.
So if you have a look at the Australian large cap universe, that quite simply is the largest companies in Australia. Most people think about the Australian large caps either being the ASX 50, so the 50 largest companies,
Yep.
or perhaps down to the 100, so the 100 largest companies in Australia. So, well, we're an industry that loves to put labels on things. We like to have things in boxes. And this is one thing where we can kind of dice up the universe and put it into different segments and perhaps look at them in separately. Market cap, from my point of view, is not a great way to decide how to invest. Just because a company is large doesn't necessarily mean it's going to continue to outperform.
Yeah.
Equally, small cap companies often have greater growth opportunities, but they're smaller, so they carry a slightly higher degree of risk to them. They're still proving themselves. Or, of course, you might have a former large cap which has become a small cap. And that might be a warning in itself,
Yeah.
depending on why that's got why that's got significantly smaller over time. So yeah, we're talking about market capitalization, and it's just a different way that the industry categorizes funds is often by market cap.
Okay. And when we're talking about how a fund performs against the index or against the market, what are we talking about there?
Yeah, so it really is a line in the sand. So a benchmark is they're generally agreed upon across the industry. So if you go and look at a range of Australian large cap funds, they'll generally have the same benchmark, and that'll often be the ASX 200. And what this is really allowing investors to do is say, looking at the track record, has this fund outperformed the benchmark? So let's say the benchmark's returned 3% over the last year. So the ASX 200 has gone up 3%. If the fund's gone up 5%, then you've made 5%, but you've also outperformed the market by 2%.
Right.
So benchmarks really should be used for that purpose. There's just simply a line in the sand for you to get a very quick indication, has this fund got a great track record of outperforming the market in which it invests? Now, I should add a caveat to that. Past performance is not a guide to future performance. So just because a fund has outperformed in the past doesn't necessarily mean it's going to outperform in the future. However, if a fund does have a good track record, I would argue there's a higher probability. And certainly if you look at a fund and it's never beaten its benchmark, and perhaps even worse, it's actually been losing clients' money, then that would be a red flag to me. So it's not in itself a reason to invest.
Yeah.
But to a certain degree, you can only judge people on their past experience, and looking at the benchmark is a good guide for that.
Right. And I guess that's why we do a SMART process as opposed to just an S process,
Yes.
because it's not just the strategy that comes into play.
Yes.
So let's have a look. I guess the next big red flag, or the big thing that people will call out, are fees.
Yeah.
Fees are always something that are forefront in our mind.
Yes.
And I would suggest that just because something is cheaper doesn't necessarily mean that it's better. It's really the value of something that we should be looking at.
You're absolutely spot on. There's a big difference between price and value in all things that you buy.
Yes.
A cheap pair of shoes might last you a couple of months, whereas if you spend a bit more money, they might last you 5 years. And that's the difference between, the price and the value. And it's the same when you're investing as well. So fees are incredibly important, both in terms of their absolute size. So are you paying 0.2% or are you paying 2%? And really, fees should be partly reflective of what is the fund actually trying to achieve.
Okay.
So if you're investing in Australian equities, I'd be expecting to pay anywhere between, say, 80 basis points and 100 basis points. By that, I mean 0.8% and 1%. There's me using that jargon again. Whereas something like small caps, so Australian small caps, so the smaller companies, you'd probably pay a higher fee. Why? Because it's a less efficient market. So I'd like to think there's a better chance that the fund manager can outperform. And fees, to a degree, do reflect the opportunity set and the ability or the potential for the manager to add alpha. And by alpha, I literally mean outperformance. I try and avoid the Greek alphabet, but that's a widely used term. So you should be looking at fees relative to performance. And you should always look at performance after fees. So if a manager's charging me 1% and they return 1%, then I would say that's not necessarily great value. Equally, though, if a manager's perhaps charging me quite a high fee, 1.5%, but they've been regularly delivering 5, 6, 7, 8%, then I would say that's relatively good value. After fees, they're generating me a good return. So you need to always look at fees relative to performance and vice versa. And then the other thing to take into account is, when I'm talking fees here, I mean investment management fee. And this is a fee that the manager charges on an annual basis. So when I say an investment fee of 1%, they're charging you 1% a year for managing your assets in this particular strategy. What some managers do is they actually charge a performance fee. And what they say there is, we will take some of our fees from our outperformance. And a lot of investors really like that strategy. Why? Because effectively the fund manager has skin in the game. What they're saying is the amount of money or the amount of fees that we charge is going to be reflective of our ability to add outperformance. So I think it's always good to look for funds which have a performance fee. What you want to make sure, though, is if they are charging a performance fee, that annual investment manager fee is perhaps a little bit lower. So that's where it's good to compare different funds. So if you do narrow down through the things we've been talking about, you've narrowed yourself down to maybe 5 funds that you're looking at, definitely have a look at the fees. How do those fees compare in absolute terms? How do they compare after taking into account performance? And if they have a performance fee, how does the annual fee and the performance fee stack up against each other?
Okay, so a couple of things that you hit on in that with looking at fees. It's not just looking at, okay, this is what the fee is, the management fee, or sometimes we see that written as an MER in a document.
We do, yes.
But that's basically a management fee.
It's basically an annual.
And it's annual. The other thing that you hit on was, we talked about active and passive. I'm guessing that you would expect to pay more for an active fund.
Absolutely. So a passive fund, you might pay around about 0.2%. And the reality there is you're going to get the market return. And the fund manager is copying the market.
Yeah.
So you shouldn't be paying a high fee for the skill set of copying something. And you wouldn't expect to. And most passive funds, therefore, will have a very low annual fee. Where a manager has perhaps got lots of resources looking at companies all around the world, then obviously they're doing a lot more work. So one, you'd expect the fee to be a little bit higher for that purpose. But also, if they're good at what they do, they should be adding performance over and above the market. And if they're doing that, then again, you'd expect to pay something for that outperformance.
Absolutely. Something else that you hit on as well, you called something an inefficient market. What is an inefficient market?
Great question. In simplistic terms, an inefficient market is one which perhaps is less understood. So if you think about the Australian large caps, what I know about the Commonwealth Bank versus what anybody else knows, very little difference. But most people probably know more about Commonwealth Bank than I do. But that information is all very readily available. There's lots of brokers and analysts looking at Commonwealth Bank. You can, go on TV and hear analysts talking about Commonwealth Bank. There's plenty of column inches out there. It's a very well covered stock, as is most of the ASX 100. And therefore, your ability as a fund manager to know something about that company, which hasn't been recognised by the wider market, is relatively slim.
Right.
Your conviction level might be a little bit higher. You might prefer Commonwealth over Westpac for some particular reason, but as a general rule, you're probably going to hold it in the portfolio, and your view is not going to be greatly different to the broader market. When you go into less efficient markets, generally the coverage by brokers and analysts is a lot less. And therefore, you can add more value as the fund manager. So you can perhaps go and sit down with the management of a small cap company, really understand what their long-term objectives are. There's a lot more companies within those markets as well. Like in Australia, there's around about 2,800 listed companies. So, we spend a lot of time talking about the banks and the mining stocks and the top end of town, but the opportunity set is absolutely huge. And the further you go down that, the less coverage there is. So there's inefficiencies there. And that inefficiency is something you can actually try and leverage. You can do your own research and perhaps find out something about that company which isn't being reflected in the share price. And equally, the stocks are a lot less traded, which can give you opportunities as well. So that's what I mean about inefficient markets. It's really about the depth of coverage and knowledge which is held within those markets.
That makes sense. Okay, so before we jump into moats and our next step, is there anything else that we need to have a look at from a strategy perspective?
Yeah, again, I would go back to the product disclaimer statement or the information memorandum and really understand what is the investment style of the manager. So some are passive, some are active, some are fundamental investors, some are top-down investors. What do I mean by that? Well, we sometimes call them bottom-up investors. And those are fund managers who are selecting companies based on their merit. So they spend all their time analysing companies. And they say, look, this is a great company. We're going to put it in the portfolio. And they build the portfolios, we say, from the bottom up based on individual companies. And they construct a portfolio. A top-down manager or a macro manager, they might be looking for a theme. So they may be looking at economic data. They may say, the Chinese economy looks great right now. We want exposure to China. And the starting point will be, we want to be in China. Then they'll go and find the companies which have exposure to that economic growth. Or perhaps they're playing a theme. I guess one very topical theme at the moment is AI. So we have fund managers out there who might be saying, look, we think AI is a huge opportunity. Let's go out there and find companies which are exposed to AI. And then they'll go out and build a portfolio around companies which have exposure to AI. So there are different ways managers can go about finding their opportunities. And then secondly, how do they go about actually identifying those companies? So some managers take a value approach. So they'll simply be looking for companies which have a low PE, which are cheap, on the basis that if they're cheap right now, over time, that value should be reflected in the share price and the share price should continue to grow. Or the managers say, no, we don't want to buy things just because they're cheap. We want to buy companies which are growing really quickly. So they'll put all their analysis into identifying companies which have strong growth prospects. So have got good return on equity, growing profits, growing margins. So there's not necessarily a right or wrong to that, but I think it's always important as an investor that you understand what is the manager actually trying to achieve and how are they going about it. If for no other reason, I think it helps manage your expectations of what you think the manager should be doing going forward. Not every manager will outperform consistently all the time. So really understanding, well, what is the philosophy and the style of the manager will give you a really good idea of what you should expect in terms of returns, what market conditions should the fund outperforming, and perhaps what market conditions might the fund be a bit of a laggard.
Following the incredible success of our standout event in Sydney earlier this year, we would like to extend a warm invitation for you to attend the Emerging Wealth Winners Conference, Melbourne 2025. This event will be held in the iconic MCG Members Dining Room. We're bringing together a standout lineup of only 7 curated ASX-listed CEOs to present the insights, the knowledge, the shared wisdom, and the strategies that help inform investors making wiser decisions on when and where to invest into. This event is sure to be jam-packed, full of the knowledge and the wisdom that you're seeking, and we encourage you to register at tipgroup.com.au. Check out the events page, and we look forward to seeing you there.
So where do our listeners find all of this information?
It's hard work, unfortunately, a little bit. It is about doing your research. So, as I say, there are websites out there which have funds listed on them, and you can do some very high level analysis in terms of what funds are available. But there really is no shorthand to this. The PDS document or the IM, the target market determination document, the TMD, they will all be available on the fund manager's website. And the PDS is a very dry document. I'll be honest, it's not something most people are going to want to read from cover to cover, but this is a highly regulated industry, and rightly so. So within the PDS, the fund manager does have to tell you who are they, what is their investment style, what is their time horizon, how do they go about investing your money, are they looking for income, are they looking for growth? So taking the time to read the PDS and really understand what the fund's objectives are is important. And then within the TMD, it'll give you indications around the liquidity of the fund, what timeframes you should be investing over, etc. So it really is about trying to narrow down that shortlist, because nobody wants to read 10 of these PDSs, I can assure you. But once you've maybe got a short list of 4 or 5 funds, it really is worth taking the time. And all the information will be there. And also on the fund manager website as well, you'll find other documentation and marketing materials, which should give you a good indication of what this manager does.
So this is probably a good time to just clarify that funds can be listed under, I guess, 2 headings. So they may be retail funds, or they may be listed as a wholesale fund. So if we're talking retail funds, then you're going to find documents like a PDS or a product disclosure statement. You're going to find a TMD, which is the target market determination, and you're going to find fact sheets. Where a wholesale fund is where you're going to find an IM, which is a information memorandum. And they would usually have fact sheets. Now, can you just clarify, who are the 2? Why are there 2?
Absolutely. So a wholesale fund really is designed for more sophisticated investors. And in simplistic terms, that's normally larger investors. So a wholesale investors actually, without going back to legal jargon, is defined under the Corporations Act. But basically, a minimum investment in a wholesale fund is normally around about $500,000. So certainly a much larger ask in terms of investing. The information memorandum will actually contain a lot of information similar to the product disclosure statement, but the rules around that aren't quite as detailed. The PDS is very much designed, or a retail fund is very much designed for smaller investors. So often the minimum investments, say $10,000 upwards. You can often contribute monthly, say $500 or more each month. And as a result, there's a PDS, which is a lot more detailed. All this is regulated. So the good news is, if you're looking at a product disclosure statement, the information in that across different funds should be consistent. So there is actually a template. So as the manager, you can't choose, we're going to talk about this, or we're going to include that in our statement. It's all regulated. So every manager has to disclose certain information. And then the target market determination document was introduced a few years ago. And that really is a much quicker and easier way to look. What is this fund doing? Is it suitable for me? How liquid is the fund? How often can I get my money out of the fund? How long should I be investing in it, et cetera, et cetera. So we, as a manager ourselves, we want people to be making educated choices. So these documents really do provide a lot of information. To say, the PDS itself can be quite a weighty document, but it is worth taking the time to read through them. And then not regulated, there are things like fact sheets, monthly reports, where again the manager will give away insights into what they're thinking about the market right now, perhaps talk about 1 or 2 of the companies they're investing in, which again allows you to build knowledge about what they're doing and how they communicate that to their investors.
Wonderful. And this might sound really overwhelming, because really we've only got through the S of our smart review here. But what we've done is we've actually built a tool called a fund due diligence checklist, and we'll make that available to all of our listeners. It'll be available in our show notes to download. And what we've done is we've taken a question set and just put it into a usable document so that you can go through, you can answer the questions that we're touching on today, and then have it set out in a checklist so that you can compare different funds and have it really easy to look through, work out what you're searching for when you're looking through these PDS, the TMDs, all of these different documents, but to just make life easier for you. So please don't leave us before downloading that document, and you'll find that in the show notes.
Join us again next week as we continue exploring the SMART process to select the right fund for your needs.
The information contained in this podcast is of a general nature and is not intended to address the objectives, financial situation, or needs of any particular individual or entity. It is provided for informational purposes only and does not constitute, nor should it be regarded in any manner whatsoever as advice. It is not intended to influence a person in making a decision. No one should act on such information without appropriate professional advice after a thorough examination of their particular situation and needs. Thank you for joining us on this episode of Teaminvest Wealth Builders. We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.